Hello, investors. Welcome back to Streetwise Economics. In 2024, the S&P 500 delivered an astounding 24% return, a performance that has left many jaws on the floor. How did this happen? Is it still a good idea to invest in the S&P 500 in 2025? What other sectors are more likely to outperform and yield some returns? Stick with me as I unpack these financial insights and explore how I plan to ride this wave in 2025. First off, this video is not meant to be taken as investment advice. I'm just a retail investor and someone who trades in the US and Canadian financial markets, and I'm not licensed as an investment advisor. Therefore, you should take this video as educational content. In 2024, it was a year that was marked by economic resilience, significant technological breakthroughs, especially in the artificial intelligence sector, and a notable decrease in inflation in the US. In Canada, the economy, especially in the last quarter, did not do really well in terms of the GDP. But back to the US, the S&P 500 essentially is an index which tracks the performance of the 500 large companies that are listed on the US exchanges, and it soared to new heights. According to financeyahoo.com, the index closed the year with a record of over 54 all-time highs that it broke. That was also an article that I found on Bezinga. Now, this all was driven by a robust economy. If you look at the job numbers, employment numbers, the GDP, the US economy was very, very strong, and also even the decreasing inflation. Now, these are attributed at least to why this index went up 24%. That means if you had 100,000 that you had invested, you would have made about 24,000 if you just put that money at the beginning of the year. Now, there are a few companies that really drove this index. If you look at Meta, Netflix, and even Amazon and Apple, and you see that this index, it has, like I mentioned, 500 companies, but most of the stocks that are listed in that index are in the technology sector. So it covers different sectors. And the good thing is that even though it's mostly concentrated on the top in the technology companies, and you see that the MAG 10, these are the top technology companies like Microsoft, and these have been really going up. And I think in terms of their earnings, they justify their growth. But there are always concerns to say, look, when we look at the average of the S&P price to forward earnings ratio, they are a little bit, they're actually quite higher than the average. And usually, research shows that if the earnings are usually above that average, they tend to be some corrections. And you see, if you look at the data, whenever there has been some correction or even bear markets, which is at least 20% drop in the index from the previous high level, then there was that situation. So, but it's extremely difficult to then say it's obvious that this year is going to be bullish or bearish. So now let's look at some credible statistics. Now, if I am planning to invest, and I have to disclose that I also have some position on ETFs that track the S&P 500 index called SPY and a few others, but I think what is important from what I've seen is that if I look at the historical returns over from, let's say, according to Investopedia, S&P 500, it has returned about 10% annually, right, from 1957. So what that means is every year, some years like the past 2 years, 2023, 2024, it returned almost 24%, right, average. But there are some years where it actually can really go down. But like I've always said, a lot of people then panic and sell only to see the market, the S&P 500 going up. Now, how do I invest in an index fund? What I've seen is that like there are different indices, like the S&P 500 index, the Nasdaq that tracks the stocks or businesses that are publicly listed in the US that are mostly in the technology sector. Now, I invest or can have that exposure in those indices through what are called exchange traded funds or directly buying some stocks that are in that index. For example, if Microsoft, as an example, or Apple is in that index, I can just buy individual stocks. But picking individual stocks, it has been shown that a lot of investors, even professional investors, they are terrible when you look at the average. Because let's say you have a portfolio of 10 stocks and you have 5 stocks that can go up 3 times. And you can have, if you don't know how to position to size your portfolio or your securities in your portfolio, they can even have a more outsized drop such that the average may be lower. Now, because in 2024, the index outperformed, right? Not just the long-term average, right? But also even many other global averages. If you look at the Eurozone, and historically also the S&P 500 has performed quite well compared to other stocks. So now let's look at it, and I'm going to show you in a second. Let's say if you had 10,000 that you want to invest, like for me, the first thing that I do is through exchange traded funds, like I mentioned an example. It's not a recommendation. SPY, which is managed by State Street Global Advisors based in New York, and it basically tracks the index, right? The S&P 500. Now, what they do, they just buy shares of those companies in a similar percentage that are like in the index. And what they then do, there's a fund manager who then charges some fees. So it's very, very important to look at the fees. For example, when I last checked, the gross expense ratio was 0.0945 for SPY. But I then do dollar cost average, and I'll show you in a minute to just show you how how I do it. But you see that if I'm using this chart, for example, you will see that this was, let's say in April, there was a drop here, right? You can see here, but it's extremely difficult to know when the market is going to drop like this. So what I simply do is I like to say if the S&P 500, now let's say in this case, I look at SPY, which I mentioned, if it drops, which I can then buy shares for, you see it mimics what SPX, the index, does, right? I like to buy, let's say there's a 5% drop, 10% drop, which is a correction. I'm so excited, but I like to just buy on red days. So what that means is I'm just buying, let's say when it drops here, or maybe it drops here, so that at the end of the day, I will have an average that is usually, below where it will be. But I'm more aggressive if it drops. But again, past performance doesn't guarantee that the future performance is going to be known, because there are a lot of nuances. Like you can see here, there was a drop here. You can see that was in December. This drop alone, it was a almost a 4% drop, right? You can see here for SPY, 3.39, just roughly, right? But you see that it's sort of uh, returned, went a back up. You can see here, I'm trying to delete, let me delete this. But it ended up coming back here. So what I like to do is usually I like to trace these levels and have these as my support levels to say each time the SPY or SPX retraces to these levels, I add shares, right? And I like to especially add some shares when this uh, when the S&P 500 is below the at these levels, right? If I look at let's say if I look at, let's say, the 50 moving average here, let me just change this to 50 moving average. So you see that for me, this is where I usually am comfortable. I am comfortable to average down, let's say at this point, right? And then it drops close to this level, it closes to this level. So right now, for me, this would be a good time to actually add some more shares, right? Even if I look at the past, usually it goes up and above this 50 moving average. And the idea for me is it's extremely difficult to predict where this will go. So now let's look, let's say I hit that 10,000, for example, I have 10,000 this year, and I regularly say, if it drops, let's say some people, they just dollar cost average, I put in, let's say $100 every month, and I'm saying I would put, let's say 7% per year, because I said historically it returns about 10. And I put this money in there for like 7 years. So I'm just adjusting for inflation here, because usually it's like an average of like that 2%, that's what the target, but it can go up. But average, you have higher and lower bound. Now you see that here, compound interest, you have almost like $417,000. So $500,000, right, by just investing this 10,000 and over 10 years. And this is not guarantees, but based on the past, right? This is something that can generate a lot of money, but I can reinvest the dividends. So now let's say if you are good at this, you invest, and then let's say you get 15%. I just want you to see the difference. You see, if you can get 15% annualized every year, that means in 30 years, this money can go to almost like 3 million. So that's the difference in terms of fees and anything that eats away the returns. What it does is that it reduces your return, and it can be, whether if it's 1% or 2% over the long term, it compounds. So I like to dollar cost average and have a longer time horizon. And by so doing, that's what I just do, but that is after I build an emergency fund. Now, if you also want to stay ahead of the curve, I do have a new weekly newsletter at www.streetwiseeconomics, and I share some exclusive insights, market analysis, and some investment insights that may be tailored for you. So you can sign up on that and be sure to subscribe so that you can get more insights. Now, looking forward into 2025. The equity markets are at a pivotal point. I've seen some trends on the financial news discussing potential corrections. However, predicting the markets, as I've said before, is notoriously difficult. So there are factors like geopolitical risks, technological advancements, economic policies, and even psychological aspects, like people may just freak out. Like, I think it was in August. I remember my family and I, we were in Washington, D.C., and there was the yen carry trade. People were borrowing in Japan and then investing in the US securities because there was a bull run. The market was going up by at least 20% from the previous low. Now, what then happened is that when the Bank of Japan announced that they were actually going to increase the interest rates, what that means that the lower interest rate, the money that those people, investors, had borrowed, it was going to be more expensive and it was going to be dicey. So they started withdrawing money in their securities in the US that they had invested in. So I saw the market dropping. Now, what then happened is the storm was over, but at the end of the day, like I've shown you, the trend continued. So that's just an example of what happens in the market, because there are a lot of nuances. But I'm keeping a keen eye on artificial intelligence and also renewable energy, which I think might continue to drive the markets. I really don't know. There are a lot of nuances, but what I do, I want to stay invested, but I would say I'm almost 50% now in cash, and I use some of the money to trade occasionally. Like I said, as a word of caution, it's extremely difficult to predict the market because if I was able to predict that I was going to make a lot of money because I was going to bet on that. So for me, the key has been managing the risk, having a hedged portfolio. That means I have other assets that are negatively correlated. In other words, if the market drops, they spike up. I've shared how I trade the VIX occasionally, but also having a bit of the portfolio in cash. I don't like doing options because of the time decay factor, but I like to also consider some invest or other exchange traded funds that have a bit of leverage. But for me, I am comfortable with that. I like to have an emergency fund, like I indicated. The idea is that I would not sell if the market drops by 10, 15, 20%. If in fact it drops by that level, I would be so excited. So I like to stay liquid, have some cash, but also have some fixed income, but a little bit of some dividends income, but also some other multiple income streams like I consult, I trade, I coach people, and I also have a spouse who happens to have a fairly stable job. So that kind of like helps in a way. Now, in conclusion, in 2024, it was a testament to the power of diversified investing, right? In the S&P 500, my portfolio, it went up clearly because I had invested in the exchange traded fund, but also individual funds. So it was really good, right? But the thing is, like a lot of people, I think I've seen some comments on social media, they sometimes may think that the market might just continue going up. That has historically not been the case, but we don't know. So this, to me, stresses the essence of at least having a bit of money, like I said, in the market, but also continuously educating myself, being patient, studying and analyzing the trends and what are the sectors that may be undervalued, and picking some individual stocks and having a portfolio that is diversified in terms of my risk tolerance. And you know what? Some people, they want to take a lot of risk, right? But for me, I'm conservative because I ask myself, if the market dropped by 40, 50, 60, 70%, how is this going to affect my financial position and also even for my family, my well-being? For me, that would be catastrophic, right? In the sense that I it can potentially, it can actually reduce our net worth. But because if you have an emergency fund, if you have some cash, it means you can go on for maybe 3, 4, 5 years and even do other things, right? That can bring income. But at that point, that would be a wonderful opportunity to actually invest in wonderful companies and only things that I understand. So I do a mix of individual stocks, also trade occasionally, like I said, but most of our money, family portfolio, I like to invest in the uh, exchange traded funds that track the S&P 500 because historically, time again and again, it has been shown that they tend to beat even more than 90% of professional and other investors in terms of the return. So the journey requires some patience and strategy in the investment, but also in conclusion, don't forget to subscribe and check out other videos and some insights that I post on www.streetwiseeconomics.com for more insights. And let's navigate these financial markets together. Thanks for watching and see you in the next video. Bye bye for now.